And we start off over here, okay, and by way of introduction, this reading aims to open up the black box of value creation in private equity, okay, and a lot of information. The authors of this particular article were able to get a lot of information from private equity funds, okay, which perhaps was confidential to some, but they managed to get hold of that, okay. And yes, we have a look at some of those factors that were prevalent in value creation private equity strategies. Very important, the first thing we start off of what we call VCPs. VCPs are value creation plans. Okay, so when a private equity firm decides to invest in, for example, a portfolio company, and if we just look at the picture, just to make sure everybody's on the same page, okay, remember, top, we've got the investors in a private equity fund, however many you may have. Let's just put 3 or 4 of them over here. These are your limited partners. Now, your limited partners then invest, okay, into a fund. We'll call this the private equity fund. Okay. The private equity fund, as we know, is managed by the general partner or the manager. The private equity fund then goes ahead and invests, okay, in what we call portfolio companies. How many portfolio companies, okay, for each and every one of these particular funds? Could be 5, could be 10, depending on the particular private equity fund. So there we would have portfolio company, etc., etc. Okay. What this particular article says is that, well, when the private equity fund over here decides to invest in a portfolio company, well, what it's going to do is it's going to come up with a VCP. The VCP is a value creation plan, okay, formulated by the private equity firm, okay, before it invests in a portfolio company. Okay, it may look at a particular portfolio company and say, well, we think we can achieve value by replacing management in that company. We think we can increase value in this particular portfolio company by purchasing new assets, etc. But there are certain points that they put into place, do private equity funds stroke firms, okay, when they enter into an investment in a portfolio company, in order to make sure that they can extract value then from that particular portfolio company. Okay, let's have a look over here. We start off over here, okay, the 5 key strategies that private equity firms use in terms of trying to, as part of their value creation plans, to extract value then from a portfolio company. They make operational improvements. They look at top line growth, and normally it would refer to revenue growth. Governance engineering, financial engineering. Now, financial engineering, when we talk about things like leverage, bringing more debt into the business, less equity, just to use a bit of those, dare we say, private equity tricks to be able to secure further value. Okay, and there's management of cash management. And as mentioned, guys, there's going to be a lot of technicalities and just data we've got to just go through. The most popular strategies are operational improvements. Okay, 84% of private equity firms use that particular strategy, and top line growth with 74% of private equity funds incorporating that strategy. Governance and financial engineering, about 50% of plans take that into account, and very few take into account cash management. Okay, something to remember, guys, and CAIA have made this very clear to us, that when you look specifically at these types of numbers, CAIA are not going to ask you what percent of private equity firms use the strategy of operational improvements. No, you don't need to know that it's 84%. What do you need to know? You do need to know that when we look at these different strategies over here, the most commonly used strategy is going to be operational improvements, not how much to contribute to things like that. You don't need to know specific return and data, things like that. You do need to know the orders though. Okay. We continue on. It's common for private equity firms to use multiple strategies, not just one strategy called operational improvements or one called top line growth. It's common for them to use many different strategies, okay? And 82% of them made use of more than one strategy. Some used even 2 or 3 strategies. On average, in this particular article, private equity firms in their VCPs, okay, made use then of, on average, 2.5 strategies. What are the most commonly used combination strategies? Well, operational improvements and top line growth, those were the 2 most commonly used strategies that were put into plans by private equity players. Second most common combination was operational improvements, top line growth, and governance engineering. And third most combined strategies, okay, were operational improvements, top line growth, governance engineering, and financial engineering. Okay. When we look at these plans, so those are the strategies, and what this article seeks to do, guys, is to break down where value creation comes really from 2 major points of view. Number 1 are the strategies, and we've spoken about the strategies up here, the 5 key strategies that private equity firms can use, and they would often incorporate these then into their plans, their VCPs, okay? Another area that we look at are specific action items. I'll change our color over here. Action items are actual items that the private equity firms want to specifically achieve. And the 3 most popular planned action items are buying new or upgrading physical assets, 66% put that into their plans, changing the mix of products and services, and pursuing add-on acquisitions. Interestingly enough, the least frequent action item that private equity players looked at was to improve inventory management. Not very much involved in that at all. So just remember, as you go through this particular article, 2 particular things we're always going to be looking at. We're going to be looking at major strategies, the 5 key strategies that private equity players look at, and then we look at specific action items or action points as well. And remember, all of this is to try and work out where the value, okay, is going to be coming from for private equity, the value creation on behalf of private equity funds. Okay, when looking at action items, okay, there's evidence of both commonality in plans and a great amount of heterogeneity. Hetero means different, okay, and what that tends to show us, specifically in terms of the heterogeneity component, is that private equity firms tailor their plans to each specific company. So when a private equity player decides to invest in a portfolio company, they may well have 5 different portfolio companies within their fund. Okay, each one will get specific attention tailored to that specific private equity fund. Okay, so it's quite an important concept that, in fact, private equity players are, in fact, focused and don't just try for generic strategies for every single portfolio company, the same strategy. Okay, we look at time trends in VCPs. Over time, private equity firms have become more hands-on and look more and more at top-line growth and governance strategies, as well as financial engineering strategies. Okay, when we look at action item levels, there's more variation over time, and in fact, purchases and upgrades of physical assets over time are becoming less popular. Again, guys, just to see what this article is doing, number 1, they look at the overall strategies, top line growth, governance strategies, and number 2, then they look at it from the point of view of specific action items that are looked at. Okay. Over the page, top of page 4, okay, variabilities of VCPs across deal type, etc. Value creation plans will vary systematically across deal type. By way of example, private equity firms look at employing far more hands-on plans for buyouts than they do for early stage deals or turnarounds. Okay. Remember, early stage deals or turnarounds, they've probably got a majority stake in the particular fund. Okay, so they can control that as needed, but maybe less so for other types of funds. Okay, deal types, we move on over here. Strategies differ across deal types. For example, operational improvements are popular in all deal types, while top-line growth, governance, engineering, and financial engineering, remember we're going back to our 5 major strategies, vary significantly. For example, top-line growth and governance engineering will increase as the maturity of the deals increase. Buyout funds, and with this we know, guys, hopefully this should be quite familiar to everybody, focus much more on financial engineering. Okay, things like leverage, debt, etc., things like that, introducing those into the portfolio companies. Secondary purchases are similar in strategy to buyout funds and a little bit less focus on financial engineering. Turnaround deals are less focused on top line growth. Okay, and what's interesting in terms of strategy, guys, cash management does not significantly vary across the different deal types. But can you see, as we go through this particularly, there's a lot of data we've got to try and remember here, because they could well ask you what is a common, if they decide to ask it in this manner, what is a common strategy related to buyout funds? Well, you need to know that they're going to focus on a common strategy of the 5 is financial engineering. Okay. When we look over here at ownership, buyout funds focus on optimizing the capital structure. We know that. Add-on acquisitions and changing the product or service mix. Okay. Early stage and growth deals focus much more on capital expenditure. Okay. In terms of ownership structure, most deals, in fact 71% according to the article, are minority investments. Private equity firms pursue hands-on strategies significantly less often in minority-owned deals, okay, and they pursue growth, governance engineering, and financial engineering in their minority-owned deals. Okay, look at growth strategy. Okay, in terms of organic, we call it organic growth versus inorganic growth. Around about 1/3 of companies grow through acquisition. Of course, then the balance of them will be growing through inorganic. Okay, focus on action items like top line growth. When we look at the geographic focus, when looking at geographic focus, approximately 50% of the deals are managed by single country funds and the balance by regional funds that tend to invest in more than one country. Okay, and when they start to invest in more than one country, they generally pursue top line growth and governance engineering strategies a lot more so than do single country funds. The relationship between action items and deal type, okay, both in terms of strategies, remember we always speak about the 5 major strategies, as well as action items, specific items that can be employed. The vast majority of strategies and action items are in fact achieved. In other words, when the private equity fund sets out their objectives in their value creation plan at inception, they generally do achieve what they set out to achieve. Okay. What's important to remember though is that there are certain items that are easier to implement than others. And what's interesting though, this is a bit scary for CEOs and CFOs, etc. Plans, when a private equity plan has got a plan to replace a CEO or the CFO, that's almost always implemented. That gets done. As well as plans to buy or sell physical assets. Those are always done. Interestingly, on the other hand, plans to increase market share or to grow inorganically, okay, via add-on acquisitions, okay, or to expand internationally, a little bit more difficult to take place. Not as commonly achieved. Okay. Top of page 5, we look at the action level item. The more time a deal spends in the private equities portfolio, and this makes sense, I suppose, the more likely an action item is achieved. Deal size has a positive impact on achieving objectives. Majority ownership increases the chance of an action item being achieved, and a focus on inorganic growth reduces the chance of an item being implemented. So the more the company focuses on inorganic growth, the less likely they are to have that item achieved. On a strategy level, strategies comprising a large number of action items are generally less successfully implemented. Maybe there's too many focuses as opposed to focusing on one item alone. A longer holding period and a larger deal size are generally associated with a larger share of strategies, actions, points being achieved. And pursuing a given strategy in more of the fund's other deals increases the share of governance engineering actions being successfully implemented per strategy. Again, guys, can you see there's a lot of stuff we've got to get through here. On the deal level, funds and private equity firms differ systematically in their ability to implement their VCPs, their value creation plans. And beyond a certain level, adding further detail to the plan just becomes a little bit counterproductive. It's not adding any value any further. Okay, we move on. Fund level. Okay, funds achieve a larger share of their VCPs if their portfolios are homogeneous in terms of deal size. The number of sectors doesn't really have an impact. The number of sectors that a fund invests in doesn't really have much then of an impact in that area. Okay. Funds are more successful at implementing their plans if they hold minority ownership stakes. Vintage year effects take into account, for example, unforeseen macro shocks. Well, it depends on which year you invested in and depends on what happened in that year, which will have an impact to you. But that shows us the role that luck plays in whether or not a private equity firm can successfully implement their value creation plan. So a lot of it is, when we look specifically at vintage year, there's a fair component of luck involved over there, depending on what happened in your specific vintage year. Okay, plan revisions, revision of the original VCP. Okay, and we define that as a change in plan in the very first year. 77% of those deals did in fact see revisions. In fact, they changed their plan during the first year, but in a minor way. Okay, the most commonly added action item is cost reduction, and obviously that was probably used to create additional value. Okay. VCP combinations that will best predict higher returns and lower returns than average. Okay, when we look at the returns on the private equity funds, this particular article focuses on two return measures: the PME, the public market equivalent, and the MOIC, the multiple on invested capital. Most combinations that were sampled generate a MOIC of greater than 1, which would indicate that value has in fact been created. Okay. However, they do not increase monotonically in popularity. What does that tell us? That there is no universal optimal strategy that will maximize investor returns in all deals and circumstances. I hope that's not bad news to people, but there's no silver bullet that works for all deals. Okay. We're looking at the PME measure. 70% of the top strategy combinations yield a PME of greater than 1. In other words, outperformance over there. Predicted returns based on planned strategies versus strategies, achieved strategies. Okay, there are ex-ante strategies, ex-ante looking forward, that do in fact have predictive power. Okay, certain of them predict higher returns, and in fact you can even have certain strategies when you look forward, they can show you that lower returns will be earned. A combination of, look at some of the strategies here, guys: top line growth, governance engineering, financial engineering predict the highest PMEs, while a combination of operational improvements, governance predict lower returns. Okay, we have a look over here, the 4 company level changes that correlate with higher returns. We see, okay, that private equity firms affect changes in their portfolio companies during the holding period. Okay, looking on the operational side, okay, what's interesting, portfolio companies significantly increased their employment, their wages, their labor productivity, and their capital intensity. Okay, on the top line side, yeah, they were able to increase sales and market share. On the governance side, here's a little bit different. They were only marginally able to increase ownership concentration, so not much of a look over there. On the financial engineering side, again, we move back to the significant contributions. They were able to reduce their effective tax rate, take advantage of tax shields, and on the cash management side, they were also significantly able to reduce their working capital needs. So we can see 4 of the 5 did in fact have some strong correlations. Okay, when measuring returns based on the PME or the MOIC, there are 4 company level changes that correlate significantly with investor returns. Okay, the more, and what are those? The more company manages to increase its sales, its EBITDA, its earnings before interest, tax, depreciation, and amortization, its employment and capital intensity, the higher the returns on deals. So those are the key 4 company level changes: sales, EBITDA, employment, and capital intensity. Changes related to governance engineering, financial engineering, or cash management didn't really correlate much with investor returns, and we're obviously not a key player over there. Guys, coming out of this particular reading, we give you some edge checkers there on page 7 and some solutions to those on page 8. But coming out of this particular reading, we can see it's not the content of this reading is not difficult to take in, fairly gentle to understand it, but to remember where everything fits in, what added value, what didn't add value, what specific strategies did, which strategies didn't. Okay, which specific action points added value, which didn't. It is a little bit challenging in that respect to try and retain all of that information. Again, at the conclusion of every reading, we come back to the beginning of it, and just to make sure, guys, do take a look again at the learning objectives on the very front page to make sure you are familiar with those.